Can you explain to me why so much financial advisory money is going into fixed income ETFs?
Sure. So you mentioned financial advisors. They're really the ones that are driving this. And the way we look at the ETF user base can split into two broad buckets. There's financial advisors, and then there's retail direct customers on our platform. And if you look at the financial advisor base, a lot of this is really driven from individual bonds and from mutual funds. That's what's fueling the growth of ETFs. And if you step back and look at the individual bond scenario, what we saw is coming out of Dodd-Frank, a lot of the banks reduced their inventory in individual bonds. So we're really seeing financial advisors replace their individual bond positions with fixed income ETFs for the first time. And that's not a trend we've really seen in the retail direct space yet. I think it's coming. I think retail adoption is slowly picking up. But really, most of the fixed income ETF growth is driven by financial advisors.
So if our financial advisors are putting all of their fixed income portfolios into ETFs, should retail investors be doing the same thing?
Yeah, I think there's an education curve, and typically retail follows the financial advisor or the more institutional space by anywhere from 5 to 10 years. So I think you're going to see that pick up over time. Another thing that's driving it, I think, is active management. In the ETF space, active ETFs are still a really small sliver of the overall pie, but financial advisors have really embraced active management in an ETF wrapper, and that's the majority of active ETF assets today is active fixed income assets.
Great. And where are individual retail investors? Where are they putting money in ETFs?
On a relative scale, we always look at the financial advisors versus the retail direct customers, and retail really have embraced sector ETFs. Sector and industry, I should say. So the broad sectors like energy, financial services, and then the more granular industries like cybersecurity for technology exposure. And I think this is really coming, again, from both mutual funds and individual stocks. This isn't strictly an active to passive story where people are fleeing active management. We think it's more of a diversification story and an asset location story. So when I talk about diversification, think about individual stocks, people who may historically have bought industrial individual stocks or consumer staple stocks for dividend income. They're buying the entire sector because they can get it cheaply and efficiently. From an asset location perspective, what I mean there is just simply it's a tax efficiency play. For people in their taxable accounts who want to decrease their tax liability, they're really using ETFs because they're more tax efficient typically than an active mutual fund.
And can you explain that? Why are they more tax efficient?
Sure. ETFs are generally more tax efficient for two reasons. One is the in-kind creation redemption mechanism, and that's a lot of industry jargon, a lot of fun, but really that means is on a daily basis when money is coming into the fund and going out of the fund, it's done on a share-for-share basis. That's a non-taxable event, whereas if you do it for cash, if a portfolio manager sells stocks to raise cash to give you the money back, that's a taxable event. That's what leads to capital gains, both long-term and short-term. So that's reason number one. The second reason is they're index-based for the most part. They have low turnover. You don't have a lot of trading activity within the portfolio on a regular basis. So those are the two reasons that ETFs are generally more tax efficient than mutual funds.